only real macro data of note due from the UK in the coming week are the unemployment and wage growth figures. Both are due out on Tuesday the 19th of February. Now in November, the last set of figures that we had, the unemployment rate came in at 4%, the lowest level since 1974. The employment rate for 16 to 64-year-olds, well, that reached 75.6%. That's the highest level since records began in 1971. And wage growth, including bonuses, ticked higher to 3.4%. Now on this chart here, we can see the unemployment rate and the wage growth figures. Now in theory, I stress in theory, the lower the jobless rate, the higher the wage growth, and the higher the wage growth, the more likely the Bank of England would be to normally nudge up interest rates. Although Governor Carney has again made it clear that the old lady of Threadneedle Street is in no hurry at all on that front. But it won't be just the Monetary Policy Committee that'll be looking at wage growth. Retailers might be as well. After all, wage growth is finally outpacing inflation, and that puts more money in consumers' pockets. How they choose to spend the extra cash remains an open question. Pay down debt, save it, spend it, and if they spend it, do they spend it on experiences or on shopping for stuff? And if they shop, do they do it online or on the high street? But traditionally, good wage growth in real post-inflation terms has tended to be good news for retail stocks, as we can see here, though we must always remember that the past is not necessarily a good guide to the future, especially given the seemingly unequal nature of the fight between online and physical retailers. It's going to be much busier on the company news front. Several heavyweight FTSE 100 firms are due to report interim or full year results, as are a good number of mid and small cap names. And they include Dettol to Sillit Bang to Strepsils personal care group Reckitt Benckiser on Monday the 18th of February. Minor BHP Group, BHP Billiton as was, and Megabank HSBC on the 19th. Glencore, Lloyds Bank and shopping centre owner and twice jilted bid target Intu Properties on the 20th. Barclays, BAE Systems, Relx and Anglo American on the 21st. And educational publisher Pearson on Friday the 22nd. But for all of the interest that lot could spark, the stock that could really cause a fuss in the week ahead is Centrica. The owner of British Gas is due to report full year results on Thursday the 21st of February. Now, as we can see from this graphic, the shares have never really recovered from November 2017's profit warning, which resulted from weak trading at the North American business and further loss of market share at British Gas in the UK energy market. Pressure from the Conservative government under Theresa May and industry regulator Ofgem, especially over prices and the cost of so-called standard variable tariffs and the ease of switching between energy suppliers, has also depressed sentiment towards the stock. However, the regulator has just announced it will raise the standard variable tariff price cap as of April, so that may give Centrica's British Gas operation a little bit of breathing room. Some analysts have in the past suggested that every £10 in the standard variable tariff adds 0.5 pence in earnings per share to Centrica, so the average cap increase of around £110 could add 1.1 pence to earnings per share, pending any further possible adjustments. Now that's quite a big swing when Centrica's forecast to make 11.5p in earnings per share in the year to December. This chart here shows the historic and forecast progression in EPS and also a headline pre-tax profit. The consensus forecast for pre-tax income is £1.24 billion. Now that compares to 124 million on a stated basis and 901 million excluding exceptional items a year ago. Analysts will want to get behind the headlines and look at the real nitty-gritty. And here, look out for details on a planned £200 million cost efficiency programme, whether trading in America has picked up, changes in UK customer numbers. According to November's trading update, Centrica had lost another 372,000 customers in the July to October period as they switched to other suppliers, and that took the total for the year thus far to 713,000. Then look at progress in adding connected home customers, where Centrica had picked up 280,000 accounts by the end of October and sales were up 50% year on year. And finally, trends in oil production, that's down in the second half judging by the third quarter update, and also the impact on output and revenues of downtime at Centrica's nuclear power stations. Now, I know that's a lot to take in, so as you can tell, Centrica is a much more complex company than it looks. It's not just British Gas. This chart here shows its profit mix in 2017, although the UK home business, in essence British Gas, was still 2/3 of pre-exceptional operating profit, with 15% from oil and gas production and 10% from supplying energy to consumers in North America. But in the end, the full year results and Chief Executive Ian Conn may be crudely judged by just 3 numbers. First, what the company calls adjusted operating cash flow, where Centrica is targeting between £2.1 and £2.3 billion for the year. Secondly, net debt, where Centrica is looking to land in a range of £2.5 to £3 billion by the end of December 2018. And finally, the dividend. Centrica is targeting an unchanged full year payment of 12 pence per share. But with earnings per share forecast to be 11.5p, earnings cover is thin at best, and some analysts fear another cut to follow those of 2014 and 2015. Now, Mr. Conn will doubtless strive to avoid a cut, so watch out for any guidance on future profit and also cash flow, because it's really cash flow that pays the dividends. If the dividend is held, that would put Centrica on a forward dividend yield of 8.6% for 2019, the 6th highest yield in the FTSE 100 at the moment. Thank you for watching, and I look forward to seeing you next time.